Hello again, my friend. In this video, I'll walk you through what depreciation is, when to capitalize versus expense an item, and how to record straight-line depreciation in QuickBooks Online. Use the timestamps below to jump to any section. In accounting, depreciation is the systematic reduction of the cost of a fixed asset over time until its value becomes zero or negligible. Think about things like furniture, buildings, office equipment, machinery, and vehicles. These are assets you buy for your business that last more than a year. Now, here's an important concept: capitalizing versus expensing. When you capitalize something, you're putting it on the balance sheet as an asset instead of recording it as an expense right away. Then you expense it slowly over time through depreciation. When you expense something, you record the full cost immediately on the profit and loss or income statement. So the question is, when do you capitalize versus expense? The IRS allows a $2,500 threshold for expensing items, but many small businesses set a lower capitalization threshold, like $1,000. If it's over your threshold, capitalize it. Record as a fixed asset. If it's under your threshold, expense it right away. And anything you expense should not be categorized as a fixed asset. So think of it like this. If you buy a $50 phone charger, you're not tracking that for years, right? You're just expensing it. Done. If you buy a $1,200 laptop, now it's a bit more significant. Some businesses might still expense it. Others might capitalize it depending on their threshold. But if you buy a $30,000 vehicle or a $5,000 machine, there's no question. You're not expensing that all at once. You're going to capitalize it and spread the cost over time using depreciation. So, small everyday items, expense. Bigger long-term assets, capitalize and depreciate. And one more thing, you cannot depreciate land. Land typically appreciates, so it's not depreciated like other fixed assets. All right, there are three things you need to figure out depreciation. First, the cost of the asset. This is how much you paid for it, including things like taxes, delivery, or getting it ready to use. Next, the salvage value. This is how much you think you can sell it for at the end. Even if it's old, it might still be worth a little money. And if you think it won't be worth anything, that's totally fine. You can just say $0 for its salvage value. Third, its useful life. This just means how many years you think the item will last. Like if you buy a truck, maybe you expect it to last 5 years before it's worn out. In my previous video, I showed you how to add a loan and an asset to your chart of accounts, and I actually used these same assets here. The Dodge Ram and Ford Fusion as examples in this video. If you haven't seen that video yet, I'd definitely go watch that first. You'll find that video here or in the description below. Now let's talk about straight line depreciation. It is the easiest way to spread out the cost of something over time. Let's break it down step by step. First, we start with the cost of the asset. In this example, that's $55,000. Next, subtract the salvage value, what you think it'll be worth at the end. Let's say that's $5,000. So now we have $55,000 minus $5,000. The difference is $50,000. Now, we take that amount and divide it by the useful life. In this case, 5 years. So, $50,000 divided by 5 years equals $10,000. That gives us $10,000 per year in depreciation. And that's the key with straight line. It's the same amount every year. No guessing, no changing numbers. It's just a straight line. And if I want the monthly amount, I just divide that by 12. Straight line just means equal expense every year. Nice and simple. Let's switch over to QuickBooks Online and let's talk about the two accounts you should have in your chart of accounts: depreciation expense and accumulated depreciation. Depreciation expense is the amount you record each period, usually monthly or yearly, to show how much of the asset you've used up. So instead of expensing the whole thing up front, you're spreading the cost out over time. Now, accumulated depreciation is just the total of all the depreciation expenses added together over the life of the asset. And this is important. Accumulated depreciation is what we call a contra account. That just means it sits with your asset on the balance sheet, but it reduces the value of that asset. So, if my truck is $50,000 and I've taken $10,000 in depreciation so far, my book value is now $40,000. Think of accumulated depreciation as a running total that slowly brings your assets' value down over time. Now let's go ahead and create the accounts in our chart of accounts. Go to the gear icon on the upper right corner. Find Chart of Accounts. Click New Account. We'll call this Depreciation Expense. This is going to be an other expense, and that means you'll see it at the bottom of your report. Detail type, depreciation. So this is where your monthly or yearly depreciation will show up on the profit and loss. Next, we're going to create accumulated depreciation, and this one is a little different. So go ahead and click New. For the name, put accumulated depreciation. Account type, fixed assets. Detailed type, accumulated depreciation. Now, here's the key thing to understand. Even though it lives under fixed assets, remember this is what we call a contra asset account. All that means is it does the opposite of a normal asset. It actually reduces the value of your assets on the balance sheet. Now, if you have multiple fixed assets, you can create separate accumulated depreciation accounts for each one. But personally, I don't. I like to keep just one accumulated depreciation account for everything. It keeps your balance sheet nice and clean. Because imagine having 5 or 10 assets and then 5 or 10 accumulated depreciation sub-accounts. Your balance sheet turns into a whole novel. No, thank you. All right, we're about to record depreciation for the year end using a journal entry. But if we haven't met yet, I'm Catherine Silverio, owner of Silver Bullet Bookkeeping. If you're a business owner and you need help with your books, call, text, or email me and let's schedule that free discovery call. Okay, let's create the journal entry. Click plus create, select journal entry. Let's set the date. Use 12/31 and whatever the year-end date is for you. If you prefer to record this monthly, that's perfectly fine. I recommend setting up a recurring journal entry for that. Let's label it something clean like YE for year end, DEP for depreciation, 2025. Is this an adjusting journal entry? Yes, it is, because it's being done at year end. It's not from a bank or a bill or an invoice. So in QuickBooks, toggle this is adjusting journal entry on. Toggle it on. Okay. For line 1, we debit depreciation expense for $10,000. And we can say something like, to record year-end depreciation expense. Line 2, we credit accumulated depreciation for the same amount. And we can say something like, to record accumulated depreciation. In the memo, we can say to record annual depreciation per fixed asset schedule. Now here's another step, and this is huge for clean books. You want to attach the depreciation schedule. Either you got it from the CPA or the table that you just created. Put it there. So click Attachments at the bottom and upload the file. Click Save and Close. Now let's check our work. Let's go to the Profit and Loss report. Depreciation expense shows here. That lowers net income. And let's go check out the balance sheet. Accumulated depreciation increases. That reduces the asset's book value. That's it for this video. If you want to keep learning, I've got another one right here ready for you. Thanks for watching. I'm Catherine Silverio.